Welcome to Then and Now, a podcast by the UCLA Luskin Center for History and Policy. We study change in order to make change, linking knowledge of the past to the quest for a better future. Every other week, we examine the most pressing issues of the day through a historical lens, helping us understand what happened then and what that means for us now.
Hello, I'm David Myers, host of Then and Now and director of the UCLA Luskin Center for History and Policy. The history of the University of California is inextricably tied up with land. The Federal Morrill Act of 1862 granted land to states in order to establish public universities. It is this act that made the UC a land grant, or as some critical scholars might say, a land grab institution. Land has not only been the foundation of the UC's physical infrastructure, it has been a source of wealth and, more recently, investment. In fact, the University of California has invested billions of its portfolio in the real estate trust of Blackstone, the massive asset manager. And here's the rub. Blackstone's real estate trust realizes its profits by raising rents of apartments and the price of homes, some of which are inhabited and owned by California state residents and even UC students. Are they subsidizing the UC's endowment? This is one of the central questions in a new Luskin Center report, Selling Sunset, Land and Financialization at the University of California, authored by UCLA Ph.D. candidates and Luskin Center researchers John Schmidt, Samuel Feldblum, and Abbie Cohen. The question of UC investment policy has become a central topic in recent weeks as pro-Palestinian protesters have called for the university to divest from Israel and companies that sell military equipment to it. As more scrutiny falls upon the UC's investment policies and practices, it is important to understand historically how the university achieved the financial position it has. And for that, we now turn to John Schmidt, Samuel Feldblum, and Abbie Cohen.
Thanks for having us. Thank you.
Thanks for having us.
Great. It's good to have you back, John and Semi, because you were involved in a prior research project of the Luskin Center for History and Policy devoted to the history of contingent labor in the University of California system. So I'm curious to know how you came to this project from that project. Was there any connection? These are two projects that take up the history of the University of California. Is there a necessary connection between the two?
Great question. And indeed, there is, I think, both a sort of conceptual connection and then a historical connection between the two reports. So this one, I think, grew really organically out of the report on contingent labor, because a lot of what we were narrating in that report was kind of the changing financial circumstances of the UC since the master plan, and then kind of the maybe the unraveling, not the unraveling of the master plan, but the unraveling of the funding model that was inaugurated by the master plan, and how the rise of contingent labor, which is not a story that's unique to the UC, but is a product or intertwined with kind of these shifting financial circumstances of the university. But I think something that happened for us in thinking about how the university has changed over time is that part of what we were narrating in that report is is longstanding decline or long-lasting declines in state funding and the concomitant rise of the endowment. And there's a very natural and kind of intuitive question, I think, that comes up with that, which is, well, why can't we just use some of this endowment? Why is the university realistically poor in any meaningful way if it has such a huge endowment? And so I think this report, in some ways, was kind of trying to dig into that question of, well, what is an endowment? What can an endowment do? How does money move through the university, and why is money available to do certain things but not other things? Is all that money available to pay professors, or, and we'll address this later, could that money be diverted to reducing tuition for students? And so this report then was kind of trying to take squarer aim at the endowment, Obviously, we then end up focusing on real estate and land in the endowment. But that was sort of the impetus for trying to understand the endowment, and it grew really organically out of that last report. And then I would just say that the other kind of piece of this is that it was nice to begin this project and have already done a lot of historical legwork on just, well, here's how the UC has changed and its funding model has changed since 1960. We got more into that, and we went further back in time with this report, but it meant that we were already sort of halfway to narrating that history to some degree.
So a common thread then in the two reports is what you call the financialization of the university. And in this report that we're here to talk about, you really place front and center both real estate and more generally land as an important component, understanding both the history of the university and this idea of financialization. So can you maybe take us back and help us understand how central land has been to the University of California?
So our story, or the story that we're really trying to tell, I think, with this report is about the role of land, and more specifically of real estate in the endowment of the UC. And we were really inspired, I think, to do this by the sort of major deal that the university announced at the beginning of last year with the private equity firm Blackstone, which we can get into the details of in a little bit. But it was a $4.5 billion investment in this massive real estate portfolio that meant that the university now has exposure to and profits from this collection of properties that extend beyond California and beyond the United States, all the way across the world. So we really thought that in order to tell this story of land and the endowment, we had to kind of go back to the beginning with the Morrill Act, because the Morrill Act is really indicative of the fact that land is sort of at the historical base for a lot of these university endowments.
Let's just make clear to our readers, when we say the Morrill Act, we're not talking about M-O-R-A-L, but M-O-R-R-I-L-L.
The Morrill Act of 1862, right? It's the piece of legislation that created the land grant university system. And what that was basically wasn't the federal government giving land to the universities to build on, but rather it was giving land to the universities to sell. And so basically the way the Morrill Act worked is that the federal government would grant what was called scrip to states, and the states would then sell that land to fund endowments for these sort of fledgling universities that were popping up. And of course, much of this public federal land had been acquired as a result of the dispossession of Native peoples, largely in the American West, which is something that a sort of new wave of scholarship has increasingly focused on. But that was the basis for the Morrill Act, was selling land to fund university endowments. And what I thought was interesting that emerged out of going all the way back to this moment was sort of seeing how there were certain strange kinds of echoes of very contemporary behavior, especially with California. So the state of California, in order to fund its university system in the 1860s, for example, was able to petition the federal government to get particularly valuable land near railroads, for example, and then sell that land at a much higher price than other universities were able to do. So there's this kind of way in which, even during this Morrill Act period, the UC is acting as a land speculator. And I thought that was just a striking kind of historical echo of what was to come.
Is it your sense that UC is an outlier, that it's a uniquely shrewd real estate investor or land speculator? Or is this something that one might expect to see in other land grant universities in other states? Something distinctive about the UC's behavior?
Well, I think that the UC was certainly able to squeeze more out of the land granted to it than other government or other university systems were able to. And of course, California more broadly is like a really important nexus for a lot of the Morrill Act activity, because I think almost 20% of all of the land that was granted to fund university endowments through the Morrill Act was in California. So there's something specific about the role of California in this story, and about the UC as well.
Right, and so part of what you do in this report is expose to the reader the long duration of the centrality of land and real estate in the UC system. And I wonder if you can give us a sense of how things change over time, because as you said in talking about the first report, the funding model of the University of California has changed dramatically over the course of time, certainly since the Morrill Act. But has real estate been a fixed asset in the funding of the university, in the life of the university? Has that changed over time, or is this kind of a constant in the midst of all sorts of other changes?
What we're finding in this report, and what a lot of scholars have traced over time, is how dynamic and shifting the history of real estate has in funding models have shifted over time, particularly at the UC, being a public flagship university. So during much of the 20th century, and as Sammy and John also reported in the heyday of the master plan, UC's primary source of funding was from the state of California. And as of the late mid-'80s, often what we consider a moment of neoliberalization in the United States, California paid for a majority, about 3/4 of the state's teaching and research budget. But as with public universities across the country, kind of in this peak neoliberal moment, state funding declined. And what has come in replacement not only has been tuition increases, which is a primary push, and one that doesn't come with a ton of strings attached. The university can do what it wants with the state tuition with the tuition dollars. But also funds have come from private actors, philanthropy, and other mechanisms of what we would describe as like market-based reforms. So I'll pause there and let Sammy and John pop in as well.
Maybe I'll just jump in to say that there's a way that real estate, there's a kind of maybe simpler would or more straightforward relationship the university has with real estate in kind of its early years. So donors are gifting smaller plots to the university, which is then recouping money either from sale of those plots or from rental income. And we had kind of a nice time in working on this report, looking in the archives at some of these early bequests of land. And a lot of them are around Oakland and Berkeley. Some were out in, say, Redlands or something, and it tends to take the form of kind of a rich benefactor just donating a little plot. And so in 1933, the university consolidated all of these gifts, not only of real estate, but also of just kind of endowed funds into the general endowment pool. And then for the next 50 years, things mostly that mostly continued to be the case. And so we have in the report, we cite a 1979 document from the university in which it's the policy of the regents not to purchase real property for investment. So that's still in 1979. That's the case.
And why was that, Sammy?
So a big piece of that, and a big kind of thrust of the historical argument that we make in this report generally, is that real estate hadn't matured as an asset class yet, and so it wasn't as available for investment for. And it was also the case that the university's endowment wasn't as large and as sophisticated then, but real estate wasn't sort of as obviously attractive as an asset class in which the university might park its endowment in order to continue to fund itself. So it's really the confluence of those two trends is the historical arc that we're tracing in the report, both the rise of the endowment and then simultaneously the production of real estate as an asset class into which that endowment could be invested.
So just to be clear, until 1979 or so, if someone were to gift a parcel of land to the University of California, it would be sold and the proceeds would be placed in the General Endowment Fund as a matter of general practice.
Either sold or leased, yeah. But there was no policy on the part of the university to invest in real estate in the way that there would be about 25 years down the line when the university shifts a formal portion of its endowment into real estate as like Sammy said, as like an asset class. So as a way of diversifying its financial portfolio.
Yeah, just some of the archives that we looked at and some of the parcels of land that we saw moving in, the 20th century were more so, here's a plot of land for X type of activity that was about research and or teaching laboratories type models rather than alternative ways to diversify and profit for the university, but rather for the focus of teaching and research.
So in thinking of that change, how do you understand the causal relationship between the emergence of real estate as an asset class and what you call the financialization of the university? In other words, is the emergence of real estate as an asset class a symptom, or is it a driver of that financialization, which extended well beyond the purchase of real estate or investment in real estate as a strategy, it would seem?
Well, I think it could be both, in the sense that becoming an asset class involves the financial industry beginning to market real estate to institutional investors like universities as an inflation hedge or as a portfolio diversification tool. So there's a way in which the financial industry itself is evolving and innovating to offer new financial products to institutional investors like the University of California. But on the other hand, there's also a way in which these large institutional investors, so we're talking endowments, pension funds, other major pools of money, are also driving the process of financial liberalization that produces these sorts of new asset classes. Because especially, and maybe we can talk about this a little bit more in detail, but especially as all of these different institutions are facing various kinds of state retrenchment, there's this general idea that financial markets can operate as a sort of alternative way of meeting their liabilities, right? So there's a way in which financial liberalization is also being driven by these large institutional investors. And that also has the effect of opening up these new frontiers of investment in things like private equity and things like hedge funds, and most importantly for our story, in things like real estate.
Do you understand financialization as a necessity born of the diminution of state funding, or as a desired strategy in its own right? Meaning, had there been no decline in state investment, would we have seen the emergence of private philanthropy as a hugely significant factor in the funding model of the university?
That's a good question, and we really we kind of take after historian of the UC Chris Newfield in sort of seeing again, not to answer every question this way, but again, sort of a two-way relationship in that regard. And so he writes about the quote unquote devolutionary cycle and makes the point that part of what allows for state retrenchment is the university's demonstration to the state that it is, at least in kind of these inchoate and incipient ways, able to fund itself in other ways. And so having kind of demonstrated that it could do things like raise tuition or depend on private philanthropy, that sort of signals to the state that retrenchment would kind of be possible. And then retrenchment happens, and those alternative funding models deepen. But it also is, there's a way that kind of my heart goes out to university administrators, and I think that maybe I shouldn't say that on the anyway. I do think that that's true, because there is sort of beginning in the 70s. There's a broader financialization of the U.S. economy, right? So it's occurring within this wider political economic context in which financial markets, capital markets, sort of become this presumptive solution to funding crunches for various sorts of institutions. And so it's not as if universities or the UC itself are acting in a vacuum, or the state of California even is acting in a vacuum, but it sort of occurs within this wider national and indeed international turn toward financial markets.
One symptom of which is a process of privatization. So governments begin to outsource services that they used to provide to private for-profit concerns. And we see a process of privatization at the public university as well, right? So these are, it seems to be, two features of the same development that you've been describing. Is privatization an important part of your understanding of financialization when it comes to thinking about the UC?
Yes, I think that if they're not synonymous, they're at least like very intertwined processes. And generally, I think people tend to understand privatization at public universities as a sort of shift to private sources of money, right? So whereas before you had taxpayer appropriation being the base of your primary operations, in a privatized environment, you end up relying much more heavily on most prominently student tuition. But the other side of this, and I think the thing that especially links it to the financial industry, is the simultaneous turn to capital markets, right? So borrowing on financial markets as a way of replacing what might in a bygone era be provided by the state. So financial markets both provide the source of debt that students take on to attend universities increasingly. And these same financial markets provide the debt that the institutions themselves rely on to make up for the loss in the appropriations that are coming from a public source.
Right. So I want to talk about that by just enumerating some symptoms, as it were, of financialization, or some of the features of financialization. Declining state revenue, the emergence of private philanthropy as a major source of funding, and with that, a significant increase in the size of university endowments. You've identified at the center of your report the emergence of real estate as an asset class. And here, what would seem to be the outlier, which you just referred to, John, is the stunning rise in the volume of student debt. All of the things that I described before that would seem to indicate, okay, we don't have state funding, but we've replaced it with private sources, and we've hired chief investment officers who are staggeringly successful generating huge returns every year, which allow for the university to expand, to grow, to recruit, to retain, and yet massive student debt. How are we to understand that seeming dissonance?
That's a good question, and that's something that we it was an earlier sort of version of this project was trying to think more squarely about the question of student debt and its relationship with the endowment. So one thing, and Abbie mentioned this earlier, is that that student tuition is kind of special among these modes of privatization because when, like state funding, it is unrestricted funding. And so the money that the school gets from student tuition, it can spend however it wants. And that is, in the eyes of the school, a good and important thing. Whereas money that's coming from, say, private donations or from, a federal grant or something like that is restricted in how it can be spent. But the other thing about student tuition is that especially for a public institution, it seems now like maybe private institutions can actually increase tuition infinitely. I just saw that Vanderbilt is charging over $100,000 a year now or something, which seems fake. But for public institutions, there's a real, because they're supposed to be serving the public, there's a real kind of political, it hits political limits, the raises in tuition, and people don't want an endlessly expanding tuition debt, right? So that in California itself became somewhat explosive in the aughts, and there were big protests against further tuition hikes. And so Governor Jerry Brown promised caps in how much tuition would be hiked in the future. And so that then kind of the fact that student tuition can sort of functionally, it can do what state funding does because it's unrestricted, but it can't replace all the lost state funding because people just don't want to pay. The public doesn't want to pay that much out of pocket to attend college. And so because of that, the school then has to also turn to these other modes of funding itself.
I think it's also helpful to just name explicitly, and colleagues at the UC, what like Hannah Appel have showed that the in-state tuition at public universities have rose by over 200 or about 243% since 1999. That is really like Sammy said about the tuition at Vanderbilt, it's like kind of hard to wrap your head around the increase that we are putting on students to pay, and then having this interlocking nature of schools, the financial industry, and the state then coming together and putting the onus on students to then pay in other ways, not only through their tuition dollars, but as we talked to in this report, through some of where they are now living, considering that the UC owns much of the properties that students lay their head.
That's another of these stunning paradoxes, which is that the university invests in real estate products, which at times makes them landlords over substantial numbers of residents of the state and even students from whom they are drawing rent. And they, as landlords, have an incentive in raising the amount of rent that is asked of tenants in order to sort of further their investment, which has the effect of impoverishing tenants and students amongst them even further. So this is a kind of set of not fully congruent factors that complicate our understanding of the wisdom of the investment policy as it stands at present. Or maybe I'm missing something. I say somewhat rhetorically.
No, I think you're right. And I mean, I think one of the things that we begin our report talking about is that the press releases that announced the deal that the University of California made with Blackstone sort of were celebrating the ability of the university to leverage its large endowment in order to make this investment on behalf of its students, employees, and the Californian public. But the sort of irony here, or the disconnect here, is that very investment also implicates the university in a crisis of housing affordability in California and in many major cities across the country. So there's a way in which the investment, the returns from the investment, are being pitched as in the public good, but there's this other way in which the public is being harmed by this sort of investment by the university. And that's why a number of unions, for example, across the UC's campuses came out against the UC's investment into Blackstone.
Okay, so that brings us squarely to Blackstone. Tell us, what is Blackstone and what is its role in your story?
So Blackstone is a private equity firm, and it's an institution that has a long-standing relationship to the University of California. So there's a history between UC and Blackstone that precedes this sort of mammoth deal that we talk about in our report into the company's real estate investment trust, which is called BREIT, Blackstone Real Estate Income Trust. There's a longer history that goes back several decades that exists between the school and the firm. And Blackstone's property portfolio is the largest of its kind in the world, and it contains a number of different properties across the United States and across the world. These include things like data centers, commercial properties, industrial properties, all of these different forms of real estate that together make up the BREIT. And most important for our story is that the BREIT is also a major housing portfolio. Over half of its assets are in rental housing. So there's a way in which rental housing plays a significant role in the strategy of Blackstone's REIT. And in January of last year, the University of California invested $4.5 billion into the BREIT in exchange for a guarantee of 11.25% annually. So that's the investment. That's the connection. Our argument is that Blackstone is a symptom and a cause as well of an affordability problem, and so this investment also makes the UC a cause of the housing affordability problem.
I just want to add to our listeners who are interested that in another Luskin Center report focused on the history of homelessness in Los Angeles, Blackstone also featured as a huge purchaser of rental properties, which had the effect, especially in certain parts of Los Angeles, of increasing significantly housing precarity. So there are common threads in a number of the various research undertakings. But there are also some unique circumstances to that $4.5 billion investment in January 2023, which is including the fact that Blackstone was in some measure of financial trouble, and UC was, in some sense, providing a lifeline. Can you say a little bit more about that?
Yeah, the context in which it occurred was that there were a number of Asian investors who were pulling their money from the BREIT, and so the BREIT at that time capped the ability of its investors to pull their money from the fund. Which then signaled to financial markets that the BREIT was in trouble, and so the investment, this large and long lasting investment from UC, was a sort of a sign of trust from I guess you might call it a trusted investing brand in this portfolio, and so and so it had the effect of calming to some degree worries about the BREIT's solvency and kind of medium term outlook. Although it continued to be the case that even in the aftermath of the deal, there was a lot of investors were pulling their funds.
So you call in your report for a new strategy, a real estate investment strategy that prioritizes affordability for the public university's constituents rather than solely fiduciary responsibility to maximize returns. Can you explain what you mean and actually tell us what you'd like to see?
In a way, my answer here is a little bit of a punt, which is, one thing we're suggesting is like, hey, UC, you should talk to some people who really know a little bit more about housing than we do, But I do think that like there's this through line in this report where we're thinking about constraint and restriction and where does agency exist in terms of doing something different, and that exists on sort of multiple levels. It's something that maybe is sort of most familiar is that debt has kind of a disciplining function on people who are holders of debt, right? So if you graduate with a ton of student debt, then that pushes you into certain sorts of careers, say, and not others. Especially more lucrative ones, but maybe also careers that specifically involve debt forgiveness, say. And the same is true to some degree of institutions. So as the UC is borrowing more on capital markets, part of what financialization then means is a kind of restructuring of university governance, and capital markets make borrowing cheaper if unions are weaker on campus, if financial professionals are involved to a higher degree in leadership, that sort of thing, right? So it restructures what's happening in the university. And then ultimately, also just the rules that exist for how the endowment is being invested come with a lot of restrictions, right? So I think it's the case that that the general endowment pool, that the investment office can spend 4.75% of the general endowment pool each year. And so in order, and that's that cap is there so that the principal isn't spent down, so that the endowment will kind of continue to rise year over year, to grow year over year, right? And that then pushes so in order to both spend that amount of money and not spend down the principal, then there the endowment needs something like 7% return and also to grow in the face of inflation. The endowment needs something like 7% returns each year, if I'm remembering our math right here. Anyway, which is kind of a long way of saying that pushes the university into kind of needing these very high levels of returns on its investments. And so part of what we're trying to, and that then comes with a certain degree of constraint, like on what the university can invest in, how sort of socially conscious it can be in its investments. And in watching these investment meetings, say, Chief Investments Officer Jagdeep Bakker is constantly kind of referencing the need, say, to the fiduciary duty that the university has to its pensioners, and that sort of thing is very real, So I guess that's a long way of saying that we want to be sensitive to the fact that it's not like the university can just invest without thinking at all about whether it sort of retains its ability to be solvent over time. But that is so the difficult question for us, and what we're kind of trying to take aim at ultimately with this report, is like, well, yes, but is there a way then to even, it is unlikely in our eyes that at least in the short term, the university is going to do something like divest from its real estate holdings. And so what we're trying to wonder is like, well, is there a different way to invest in real estate? The university does try to tout that around campuses and in its real estate investments, it tries to keep things affordable, especially for students, but kind of generally as well. And so we're trying to understand, well, like how could that be done? How affordable can things be kept? Like what options are available to the university to kind of invest both in a way that doesn't mean that the university like becomes insolvent and falls apart, say, but also, with a very real eye, not only toward quote unquote fiduciary duty to make all its principles grow as much as possible, but also really trying to take into account affordability for the various constituencies of the university and for the Californian public generally. And so, so then our kind of punt answer, and I'll kick it over to you all in just a second here, but is, well, there's all these housing experts, there's all these housing scholars at different campuses across the UC, and they should really be tapped with an eye directly toward addressing this question of what options are available for an institution of this size and with a pool of capital this large. Like what might be done. And I'll say, I'll just speak for myself, I guess. I'm no housing scholar, so I don't feel like I know the exact answer to that, but maybe you all do.
I definitely am not a housing scholar either, but I do think that there is something to be said about so much of what Sammy just shared underlies a kind of normalization that finance and financialization is the way forward and has been the way forward in order to make a profit, but is not, and we've kind of report on this and many others do as well, discounts the community and the people that are impacted most intimately. And so I think one of the things we're also saying is who is in the room making decisions about the future of the university are often people who are coming from the financial sector and are speaking from a very narrowed experience. And we would like to see, one of our policy recommendations is to diversify the regents to actually resemble the community in which the universities are serving this broader public that we have been talking about. And I also think we would be remiss to not also mention the current climate that we are having this interview podcast about, which is a political one in which students are all around the country in what is being called as encampments, asking for the universities to divest from the growing from weaponry that is being used in Gaza and other military equipment like checkpoint technology in the West Bank. And these are students, once again, that we've seen since really like activism on campus beginning in 1965 with South Africa apartheid, demanding a divest and calling for a divestment from universities. And I think what our report is also speaking to is a broader awareness and phenomenon that the endowment is a political tool. It's an economic tool and one that can be shifted just like it was shifted as we trace over time. So we can shift it again. And I think part of our policy recommendations is to think with others who can help change that agenda to be more student facing and to the university contingent and constituents who are experiencing it day in and day out, not just those that may profit off of it down the line.
So as a final question, would you recommend that the University of California recalibrate its portfolio to eliminate products like the B right or diminish its holdings in real estate in favor of sort of larger investments in equities? Or are you suggesting that the management of the UC's real estate investment should be more considered and more mindful of the multiple needs, not only supplying sufficient resources to the pension plan, but also providing affordable housing to members of the university community and those in whose presence they are embedded, sort of the wider community? What would you say to the chief investment officer of the UC if you had 30 seconds?
Well, I think like Sammy said, we're not housing scholars. We're also not investment managers. So I don't pretend to know as much about how the university's various assets should be allocated as the chief investment officer does. So I think for us, it's less about the specific allocations across one asset class or another and their various relative weight, but rather it's about beginning to think about the consequences of these investments in terms of the effects that they might have on things like the affordability of housing in California, or the affordability of housing for the university's students, the affordability of housing for renters across the country. I think for us, it's about expanding a mandate that the CIO alludes to quite often about environmental, social goals in a much sort of deeper and more considered way. So I think that looking at things like eviction rates or quality of life for tenants when deciding what sorts of investments to make in the real estate sector could be an incredibly reasonable form of ESG investing in real estate. And I also think that there is some room for the university to leverage its sort of substantial position as both an institution and as an institutional investor to make demands on the market to meet those sorts of goals. And I think if the university is able to do something like this, it can really begin to think about investing with a public purpose in mind.
So on that worthy and sensible note, I'm going to extend thanks to you, John Schmidt, Abbie Cohen, and Samuel Feldblum, authors of a new report from the Luskin Center for History and Policy that explores the way in which the University of California has used its investment in real estate. Thank you for making time out of your schedules to be with us today on Then and Now.
Thanks for having us.
Thanks, David.
Thanks, David.
Thank you for listening to Then and Now, a podcast by the UCLA Luskin Center for History and Policy. You can learn more about our work or share your thoughts with us at our website, luskincenter.history.ucla.edu. Our show is produced by David Myers and Rosalind Campbell, with original music by Daniel Reichman. Special thanks to the UCLA History Department for its support, and thanks to you for listening.